recently a change with the amortization. The
Yeah.
30-year amortization now.
Which is great.
Yeah.
Really, really nice. They made a couple changes actually, and one that took effect back at the start of August, which allowed for first-time home buyers to go over a 30-year amortization, which will reduce their payment. I totally get that there's potentially a little more interest over the long term.
So it's only for first-time home buyers.
First-time home buyers,
Okay.
so bear with me on that one for a sec. So August 1st, they brought it out that first-time home buyers could go to 30-year amortizations on new construction builds.
Okay.
So whether that's, as you mentioned, a turnkey build or a draw mortgage, which that's where a client owns the land, right? And takes draws to pay the builder every so often.
Right. Yeah, we'll touch on that. Maybe we'll go into that in a little more detail shortly.
Yeah. So that change took effect August 1st.
Okay.
Just recently, they brought out, taking effect in December, that all first-time home buyers can buy any house, whether it's new construction or whether it's resale, 30-year amortization.
Okay.
But also, any person on a new construction home, doesn't have to be a first-time home buyer, can now do 30-year amortizations with as little as 5% down.
Okay, so let me get this straight. So first-time home buyers, whether it's new construction or not, can apply for 30-year amortization.
As of early December.
Coming up.
Yeah.
But what was the second part?
Second part is anybody buying a new construction home, whether you're a
first-time home buyer or not.
Yeah. So
okay.
if I own a home. If I want to go buy a new home by yourself, I can go with 30 amortization with minimal down payment.
Okay.
Yeah.
And what is the? I know this might. We'll talk through it. I know it's probably better illustrated in written form, but what is the minimum amount that, say, a first-time home buyer is going to need to have down?
Yep.
5%?
Yep.
Okay.
So 5% on your first 500,000.
Okay.
And then once you get over 500,000, however much is over 5, it goes up to 10%. Right.
And then then it changes again at $1 million bucks?
Well, CMHC, so they brought it out. That's another change that's going to happen as well. They used to only insure mortgages up to $1 million. So if you had a purchase price of $999,999, you could put a minimum down payment down, which would be between that 5 and 10%.
Okay.
Right. Now they're changing that they're going to be able to, insured mortgages can go to 1.5. So that's a new change that's going to take effect on that December change they have. So, in the Halifax market here, it's going to be significant for.
So you could buy up to $1.5 million on purchase price and still put only 10% down?
Yeah, it'll all depend. Like, again, it's 5% on that first 500,000, and then it gets tiered as you go up.
Okay.
So the exact penny, I couldn't tell you this very second, but yeah, the minimum down would probably be under 10% for sure.
Sure.
Say, and I'll plug RBC here for a second, is with our builder program, the nice part is if you're telling me the build's going to take 12 months or 14 months or 9 months, no matter what it is, we give you that approval for that, let's call it 12 months. That client's approved for that 12 months. We're not going back. If nothing changes on the contract price, we're not going to check anything a month out prior to closing for something to happen like that. You're approved, you're done. And that's something that we love, because for you as a builder, it provides that comfort that nothing, as long as the build price doesn't change, this client's fully 100% in, right?
Sure.
And the nice part is, I had some clients in COVID. The way we do it is we add a little bit of a premium on to lock in that rate for a long period of time. I had clients that near the end of COVID, when rates started going up, they might have locked in that 12-month rate for 2.8%. And when they actually closed on their house, the real rates were like 4 and 5%, but they were able to grab that 2.8.
Yeah, that's a lot of money on.
It's a lot of money,
or whatever it might be.
big time. But security for you, that's the most important part, right? As a builder, any builder for that matter.
It's risky. There's always some element of risk. You start building a home for someone today, and they don't pay for it till it's finished, and that finish line is, roughly a year out.
That's right.
For most builders, for almost everybody. So. We've talked a bit. Mortgage rates have come down. We won't talk specific interest rates and mortgage rates, because we're all well aware that can change, and I'm not trying to hold you to anything, but they've come down, and we're in mid fours.
We're
mid
fours right now, yeah. And generally, yeah, the trend is they're starting to come down. Like when you look at specifics on one side, I can say 9 months to a year ago, like we're talking about rates in the 6s.
Yeah.
Right? And now we're in the mid 4s. Now you've seen the Bank of Canada, you've seen the U.S. Fed start to drop their rates. Right? Next Bank of Canada announcement here is late October.
Yeah.
Be interesting to see what they do at that point.
Sure. Yeah.
Right.
Yeah.
So,
but realistically, mid-fours is a pretty reasonable borrowing rate at anything, whether you're talking mortgages, car loans, whatever it is. Mid-fours is pretty doable.
Well, right? And you've been home building for how many years?
19. It'll soon be 20 years. Yeah.
Right. As you said, fours is pretty good if you look at it over the last 20 years.
Sure it is. Sure
right?
it is. Yeah.
It's just those seem so high right now because people still look back 4 years ago during COVID
2%.
when they were 1% and 2%.
Yeah, sure.
And like, oh, this is so high. But in reality, it's not. It's right where they have been. And I always say, like, the few days to months before COVID, like, the rates were in those high threes. Right?
Yeah,
we're not far off that. Right?
Yeah, we're getting there. You know, especially if we talk first-time home buyers here for a minute. And in fairness, we don't build a lot of homes for first-time home buyers. I'd love to. There was a time when we did more of it than now, but unfortunately, a combination of new construction pricing and land pricing has pushed the cost of the starting point, I guess we'll call it, of new construction for single-family home builders like myself. I don't build condos and I don't build townhomes for sale. So single-family units have been pushed for when it comes to most first-time home buyers. Not a lot that are considering new construction, you know, because we're probably starting somewhere 600 and up these days.
Yeah.
So if you're searching for a home at 400,000 or 450, it's going to be a tough thing to find. I'd love it. I wish I had 100 of them that I could build tomorrow.
Right.
But it's just the math just doesn't.
Well, the land
alone is
becoming expensive. Yeah, absolutely. Yeah. And that's one thing they've realized. Like, these changes are Canada wide. They're not Nova Scotia and they're not Halifax, right? So you got to take into effect everywhere in Canada. The nice part is you know what, they've gone to 30-year. Again, you're going to pay a little more interest, but you know what, it's going to keep that payment a little lower. That 400, 500 budget you're looking at, that might be able to go 500, 600 now.
Okay, yeah.
Because of that 30-year amortization, right? Could be the same payment as that previous.
Right.
That doesn't change the effect that they still need to have the down payment.
Right.
Right? Which is difficult now, especially with like rent prices.
Yeah, sure. It's hard to save.
It's hard to save. It's very hard to save in this world. Groceries, rent, you name it. Yeah. You know, life's expensive.
Yeah, sure is.
I like to talk about the difference in a pre-approval and approval is your pre-approval is approving you as a client. Mm-hmm. Saying this client has good credit history, the income, everything is supported to purchase a house that's $700,000. The difference in an approval is the approval now takes you as the client, which we've already got you pre-approved, but we also have to approve the house or the property.
Yeah, it's property specific now.
So it still does take a little bit of a time. So why we always recommend getting that pre-approval there is I have your income documents. I have everything up front. You mentioned it. You have 10 days to get this stuff in order. Right? I don't want you chasing around T4s, asking your boss for a job letter. You're locked out of your pay stub system.
You don't have time for that.
You don't have time for that. If we have that up front, that's one thing off your plate that you don't have to worry about.
Yeah.
Let us do this. If an appraisal is needed to confirm the house as an approximate value, great, we do that, and then we give you that official approval. So the big thing, pre-approval is you as a client, approval is you and the house being fully approved.
Yeah, that's a good point. That is a good point. There's a good distinction between those two because people will even use that pre-approved thing fairly loosely. I'll get people that will say, yeah, we've been pre-approved for X, and then you kind of talk to them a little bit longer and you realize they completed one of those online calculators and it spit out a number based on the information that they put in, and perhaps they're correct, but not quite the same as if they've been speaking with a mortgage specialist who has confirmed their employment documentation and done a credit search and knows all of those things and then says you're pre-approved for.
I'm not giving a pre-approval letter unless I have all the income docs.
Right.
I mean, you can tell me I make $60,000 a year. Well, you know what? Show me.
Sure. Yeah, of course. Because you're going to ask for it when the time comes to get specific. So yeah,
that's right.
You want to do that ahead of time.
The last thing you want is you saying, yeah, it's $60,000. Okay, you're pre-approved. And then you actually get the income docs and it's $56,000. I get it that it's close, but hey, sometimes that's the difference in what you want and what you don't want.
Yeah, don't round up your income.
No,
don't
not at all. And guess what?
If anything, round it down.
That's
baby.
it. That's exactly
If you make 56, call it 55. Leave yourself a little wiggle room. Mm-hmm. You mentioned on one thing was that I wanted to pick your brain on was just general advice that you'd have for folks when they're at that stage where, maybe they've saved up what they figure is going to be 5%, let's say, of whatever value they've determined is affordable for them. That's the other thing too that I always tell people there is what you can get approved for, what the lender will give you, and then there is what you're comfortable spending every month on a mortgage payment. And those two things are not necessarily the same, but it's the latter that's most important.
That's right.
Don't make yourself house broke.
Well,
right?
you got to look when you're doing an application. You may hear people talk about debt servicing and what percentage of your income goes towards bills. That's one of the things that we look at when we're doing a mortgage application. But everybody's is different, right? So someone might have daycare costs and someone might not.
Sure.
And that doesn't take effect in certain positions. So it's really a case-by-case basis that you got to look at and say, you're exactly right. You might be able to afford $2,400 a month, but I might not because I have $1,200 in daycare bills.
Sure.
So even though we're pre-approved for the same amount, we're kind of not because it's just not comfortable for me.
Sure, yeah.
So
absolutely.
You're absolutely right. And that's when I say every client, every situation is different. And I like to talk to the client about that rather than giving them a number.
When you look at credit rating nowadays, you see commercials every day on TV. But now there's an app, or many of them, you can track your own credit. You can keep track of where your credit rating is. Is there a certain number that, because I find some people get really obsessed with that.
Yeah.
Right. But at some point there's got to be a number where, it's just kind of good enough. It's beyond that's great, but you know what I mean? I wouldn't.
Yeah. I mean, a lot of it depends on some background history, but usually if you're 700 plus, you're
sure,
okay.
Yeah, that's what I figured.
Like 900 is a perfect credit score.
Right.
I've been doing this for 15 years. I've seen 8 perfect credit scores in my life. And I'm doing a lot.
Yeah, and there are some things that happen to the folks that are used to determine that credit score that aren't quite so straightforward. Like folks just think, if you pay your bills, you'll have perfect credit, but there's a little more to it than that.
Utilization, how much you're using, how much is left, making sure you're making full payments on time and how long you've had it too. Mm-hmm. I talk to people in their mid-20s and they're like, oh, my credit score is not as high as I want it to be. I'm like, part of that's just age.
Part of that's you're in your mid-20s, yeah.
You're in your mid-20s. You don't have a lot of credit history to have, let's say, that perfect score.
Sure.
Right? But that's not saying your credit's bad.
Right.
Your credit's really good for your life stage, and it's not stopping you from potentially getting a home.
Yeah, that's important.
So I have a lot of those conversations with clients about that, and I'm like, hey, your credit score is 815. Like,
yeah, you're good. Sure.
Pat on the back. That's a good score.
And that's just one part of what you need to be concerned with. There's credit rating, income, other debts and payments that you have, and student loans, and car payments, and all those things. Debt service. There's a number of things you guys look at, obviously. That
the
beyond
big ones,
credit rating,
credit bureaus,
yep.
which is your credit rating, and then your debt servicing ratio, which I mentioned is your income. What percentage of your income is to bills that basically report in your credit bureau, and your mortgage, and your heating, and lines of credits, and visas. That incorporates what your income is and everything. So that kind of does everything as one. So that's what I say. Debt's not a bad thing, but you just don't want to necessarily have, people have car loans.
Sure.
That's pretty standard in this world right now, right? I get it. When I pull a credit bureau, 9 times out of 10, there's a car loan there, and that's fine. It's just the other stuff that you just want to make sure is getting paid down, because the lower it is on the value, the less it's affecting that ratio, which potentially the more you can get in your house.
Right.
Right. But
what about,
it's interesting.
Sorry, I mean, cut you off there, but what about, I was just thinking about income. When you said that, I thought popped in my head. It was always, and I assume it's still the same case, that there's a bit of a challenge when it comes to self-employed income. Those folks are fighting a bit of a different battle than other folks. And it used to be a 3-year thing? Is that still roughly the same idea?
We use 2-year average.
2 year?
Is what we use. We use 2-year average on self-employed income.
Okay.
There is some special programs that you can have with something because I get it. We understand. I mean, you're self-employed builder. Your situations are different.
Sure.
Right. Writing down income, doing other things. So
it's just so many people are self-employed now.
Right.
Though, right. It's not, business owners aren't the traditional business owners where you have to have
your box
bricks
store
and mortar store.
Absolutely.
And a bunch of employees. You could be self-employed. You're just one person.
That's right.
Whatever it is.
Consultants,
exactly.
real estate agents.
Exactly.
Right?
Yeah.
Perfect example, real estate agents. So, we have some special programs around stated income to be able to do some things with their income. But again, it all dependent. If their 2-year averages are great, hey, there's just the same as doing a normal mortgage application for a salaried employee.
Okay.
But the 2-year average, and the reason why that is we just want to see if what you're doing is sustainable, right? We don't want to have 1 year of $95,000 income, 1 year of $31,000, the next year at 92, the next one at 30, right? Like that's a very tough situation. It's up and down and it's very volatile. So we just want to see at least a couple years in a row. Very, very similar to a salaried employee when we use bonuses, right?
Sure.
If you get a bonus, let's see your 2-year average on your bonus.
Okay.
Right?
Yeah, that makes sense.